Risk management mistakes that kill more prop challenges than bad trades. You can have the best trading strategy in the world, but if you make even one of these 4 risk management mistakes, your prop firm challenge is over. These aren't complicated technical errors or advanced trading concepts. Nope, they're simple, emotional mistakes that destroy accounts in hours, not days. Every single one of these mistakes is avoidable, yet they kill more prop challenges than bad trade setups ever could. In this lesson, you'll see exactly what each mistake looks like in action, understand why traders fall into these traps, and learn how to avoid them so you stay out of trouble. Avoiding common risk management mistakes. These 4 mistakes kill more prop firm challenges than bad strategies ever could. Here's what they look like, why they're deadly, and how to avoid them. Mistake number 1. Revenge trading, the emotional death spiral. What it is, after a loss or a series of losses, you immediately jump into another trade with a bigger position size to make back what you lost. Why traders do it? Losing hurts. Your brain screams, I can't end the day in the red. So you double down, convinced the next trade will recover everything. Example. Trade 1. You risk 1%, $1,000, lose minus $1,000. Trade 2. You risk 1%, $1,000, lose minus $1,000. Revenge kicks in. I need to make back $2,000 now. Trade 3. You risk 3%, $3,000 to recover faster, lose minus $3,000. Total damage, minus 5% in 1 day daily limit violated. Challenge over. What just happened? You broke your daily loss limit, minus 5%. You violated the hidden risk rule, risked more than 1% on a single trade. Your challenge ended not because of your strategy, but because of your emotions. How to avoid it? Set a 3 strikes rule. After 3 losses in a day, stop trading.
No exceptions.
Never increase position size after a loss. If anything, reduce it. Walk away, close your platform, go for a walk, and come back tomorrow. Remember, you don't need to recover losses today. You have weeks or months. 1 bad day doesn't matter unless you turn it into a catastrophic day. Mistake number 2. Stacking trades, the silent account killer. What it is, opening multiple positions in the same direction at the same time, which adds up your total risk beyond your limits. Why traders do it? You see a strong trend and think, if 1 trade is good, 3 trades are better. Or you add to a winning position without realizing you're piling on risk. Real example. You risk 1% on euro to US dollar going long $1,000 at risk. You see US dollar to Japanese yen also looks bullish, add 1% long $1,000 at risk. You notice pound sterling to US dollar breaking out, add 1% long $1,000 at risk. Total risk, 3% across 3 correlated trades. What just happened? All 3 pairs move with USD. If USD strengthens, all 3 trades lose together. Your 1% per trade rule just became a 3% on 1 market direction mistake. If all 3 hit stop loss, you lose 3% instantly, and prop firms flag you for exceeding hidden risk limits. Even worse variation, adding to 1 position. Entry 1. 0.5 lots at 1.1000, 1% risk. It's working. Entry 2. 0.5 lots at 1.1050, another 1% risk. Entry 3. 0.5 lots at 1.1100, another 1% risk. Total exposure. 1.5 lots equals 3% total risk on 1 trade idea. How to avoid it? 1 idea equals 1 trade. No matter how bullish you are, stick to your risk per trade. Check correlation. If trading multiple pairs, make sure they don't all move together. No pyramiding in prop challenges. Scaling into positions is for funded accounts with a cushion, not for challenges with strict limits. The rule: your total risk across all open positions should never exceed 2 to 3% of your account. Period. Mistake number 3. Ignoring slippage and spread, the hidden loss multiplier. What they are. Spread. The difference between the buy price and sell price. You pay this cost the moment you open a trade. Example, Euro to US dollar shows 1.1000/1.1002. The spread is 2 pips. You lose 2 pips instantly when you enter. Slippage. When your stop loss triggers at a worse price than you set, usually during high volatility or news events. Example, you set a stop at 1.1000, but it triggers at 1.0995 because the market gapped down. You lost an extra 5 pips. Why traders ignore them? They seem small. What's a few extra pips? Example, volatile market during news. You plan to risk 1% equals $1,000, 50 pips stop on Euro to US dollar. Spread during news, 5 pips, instead of the usual 1 to 2 pips. Slippage on stop loss, 10 pips, market gaps through your stop. Actual loss, 50 plus 5 plus 10 is equal to 65 pips equals $1,300, 1.3% risk, not 1%. Over multiple trades. 5 trades with 0.3% extra slippage/spread equals 1.5% extra loss. You budgeted for a minus 5% daily limit, but slippage pushed you to minus 6.5%. Daily limit violated challenge over. How to avoid it? Avoid trading during major news. NFP, CPI, Fed announcements equals huge spreads and slippage. Use limit orders when possible. They guarantee your entry price, though not always fills. Build a buffer. If you plan to risk 1%, assume you might actually risk 1.2% due to slippage. Check spreads before entering. If Euro to US dollar normally has 1 pip spread, but suddenly shows 8 pips, don't trade. Remember, in prop challenges, every pip counts. Slippage is like a hidden tax that can push you over limits without you realizing it. Mistake number 4, changing lot size mid-challenge, the erratic trader. What it is, randomly adjusting your position size from trade to trade without a systematic reason. Why traders do it? I'm feeling confident. Increase lot size. I'm on a losing streak. Decrease lot size. This setup looks amazing. Triple the lot size. No plan, just vibes. Example of an erratic equity curve. Trade 1. Risk 0.5%, 0.5 lots, win plus 1%. Trade 2. I'm hot. Risk 2%, 2 lots, lose minus 2%. Trade 3. Need to be careful, risk 0.25%, 0.25 lots, win plus 0.5%. Trade 4. Big opportunity. Risk 3%, 3 lots, lose minus 3%. Net result, minus 3.5%, but your equity curve looks like a heart rate monitor. What prop firms see. Inconsistent risk equals inconsistent discipline. Wild swings equals emotional trading. No system equals gambling, not trading. Result, even if you're slightly profitable, they might flag your account for review or reject your payout. How to avoid it? Pick one risk amount and stick to it. Whether it's 0.5%, 0.75%, or 1%, use it on every single trade. Calculate lot size per trade. Don't eyeball it. Use a position size calculator based on your stop-loss distance. Never trade based on feelings. I feel confident is not a risk management strategy. Track every trade. Keep a journal showing consistent risk per trade. Prop firms love to see this. The formula that never changes. Position size equals account balance times risk percent divided by stop loss in pips. Example, account, $100,000. Risk, 1% equals $1,000. Stop loss, 50 pips. Position size, $1,000 divided by 50 equals $20 per pip equals 0.2 lots. Use this formula for every trade. No exceptions. The common thread, discipline over discretion. Notice what all 4 mistakes have in common. They're all emotional decisions disguised as trading decisions. Revenge trading equals I feel angry. Stacking trades equals I feel greedy. Ignoring slippage equals I feel rushed. Changing lot size equals I feel confident/scared. Prop firms aren't testing if you can pick winning trades. They're testing if you can follow rules under pressure. The traders who pass aren't smarter or luckier. They're just more consistent. They treat risk management like a checklist, not a suggestion. Your new mantra: same risk, every trade, no matter what. That single sentence will save your challenge more than any indicator ever could. Key takeaways. The 4 account killers. Revenge trading after losses. Never increase position size. Set a 3 strikes rule and walk away after 3 losses in a day. Your challenge isn't ending today. Don't let emotions make it end today. Stacking trades. 1 idea equals 1 trade. Correlated positions compound your risk invisibly. Keep total exposure across all positions under 2 to 3% maximum. Ignoring slippage and spread. These hidden costs add 0.2 to 0.5% per trade. Avoid news events, check spreads before entering, and build a buffer into your risk calculations. Erratic lot sizing. Calculate position size with the formula every single time. Account times risk percent, divided by stop loss in pips. Same risk percentage. Every trade, no exceptions. The real test. Prop firms don't care if you can spot good setups. They're testing if you can follow rules under pressure. Your protection protocol. Fixed risk per trade, 0.5 to 1%. Stop after 3 consecutive losses. 1 trade per market direction. No trading during major news. Position size calculator. No guesswork. Remember, every mistake above is emotional, not technical. Discipline isn't what you do when you're winning, it's what you do when you're losing, tired, or seeing the perfect setup. Same risk, every trade, no matter what. This single rule will save your challenge more than any strategy.